Today we're going to be looking at classic Japanese candlestick charts. Candlestick charts were first used in Japan over 2 centuries ago by rice traders to chart rice prices. This system of charting has been around for a long time and can be very valuable to traders everywhere. Japanese candlestick charts are now widely available on the web and in most software packages. So what makes Japanese candlestick charts different from Western charts? Japanese charts use individual lines that look like candles, hence the name, and are comprised of a real body and shadows. There are a number of formations that can take place, both bullish and bearish, that you can use Japanese candlestick charts on. Looking at a textbook example of the belt hold line, we can see that a bullish belt is a tall blue candlestick that opens on its low price. At a low price area, this is considered a bullish signal. On the other side of the coin, a bearish belt hold line is a long red candlestick that opens on its high. When this occurs after a significant run and at a high level, it is considered a bearish signal. Here's a real-world example of a bullish belt hold line. This is in Amazon. Can you spot where it is? That's right, congratulations, you found it. Now let's take a look at a bearish belt hold line in another stock. Here's another example of a belt hold line. This time it's bearish. It's real world, it's Yahoo. Can you spot where that bearish belt hold line is? Yep, you found it. Congratulations. Let's move on to our next candlestick formation. Our next example is counterattack lines. With counterattack lines, a market gaps sharply lower or higher on the opening and then closes slightly unchanged from the prior session's close. What this represents is basically a stalemate between the bulls and the bears. Here's a real-world example of a bullish counterattack line. We're using Michael Kors, which is a well-known stock. Can you spot where the counterattack line takes place on this chart? Congratulations, you found it. They tried to push prices down, couldn't do it, and look what happened. Prices went higher. That's what counterattack lines do. In this example, we're looking at a counterattack line that's bearish. We're looking at the stock Organovo, and you can see quite easily where this comes in. So can you spot the counterattack line? Congratulations, that's exactly where it is. And look what happened to prices afterwards. They went lower. One of my favorite Japanese candlestick chart formations is dark cloud cover. The name really tells you the story. After a long uptrend, a long blue candlestick is then followed by a red candlestick. The next day, the red candlestick closes well into the previous day's blue candlestick. If you wanted to put a number on this, I would say about 2/3 into the blue candlestick. Here's a great example of a dark cloud cover and why it's one of my favorite setups. Can you spot it? That's right. Congratulations, you found it. Like the name suggests, an engulfing pattern is when a candlestick line engulfs the previous candlestick line. This happens in both bullish and bearish scenarios. Confirmation in the direction of the engulfing pattern the next day confirms that you have either put in a top, which is a bearish engulfing pattern, or you have a bottom in place based on a bullish engulfing pattern. Here's a good example of a bearish engulfing line. It's on Facebook. Can you spot it? Now, a bullish engulfing line would just be the reverse. Let's see if we can spot this one. Congratulations, you found it. Now let's look at some other candlesticks. Another one of my favorite formations, a doji, is created when the opening and closing prices of a particular market are almost the same. There are different varieties of doji lines, such as gravestone or long-legged doji. When you see a doji line on any chart, pay particular attention, as it is one of the most important individual candlestick lines you'll discover with Japanese candlestick charts. A doji star is created when the market gaps from either a long blue or red candlestick. You will want confirmation the next day that it is a valid doji star. When the market closes in the reverse direction of the previous trend, a reversal has taken place. Okay, we're looking at the stock CVR Energy. Can you spot where the bearish doji star starts? Great, you found it. It's not that difficult once you get your eyes accustomed to looking for these formations. Now let's take a look at some other doji formations. An even stronger formation is a morning doji star. Like the evening doji star, This is the same formation except in reverse. When you see this type of formation, it is a strong indicator that a bottom has been put in place and that the trend has been reversed. Here's a good example of a morning Doji star, which is bullish. This is in the stock City group, symbol C. Can you spot it? Congratulations, you found it. Now let's move on. An evening star is a major top reversal pattern formed by 3 candlesticks. The first is a long blue real body. The second is a small body, either blue or red, which gaps higher to form a star. The third is a red candlestick which closes well into the first session's blue real body. In this real-world example of an evening star, we're looking at the stock Trina Solar, symbol TSL. Can you spot the evening star? Congratulations, you found it. Now let's move on to our next candlestick pattern. An evening Doji star is the same formation as an evening star, except the middle candlestick, i.e. the star portion, is a doji instead of a small real body. Because there is a doji in this formation, it is considered more bearish than a regular evening star. Here's a real-world example of an evening doji star. Can you see where it is? That's right. It's a clear-cut example. This is on CVS Caremark. Now let's move on to another candlestick formation. A morning star is the same as an evening star, but just in reverse. This major bottom reversal pattern can signal the reversing of major downtrends. A morning star signifies a major bottom and reversal. Can you spot it on this chart of Qualcomm? That is correct. You're well done. Now let's move on to look at some other candlestick formations. A harami consists of 2 candlesticks in which a small real body holds within the prior session's unusually large real body. The harami implies that the immediately preceding trend has concluded and that the bulls and bears are now in a state of truce. The color of the second real body is not that important, but most often the second real body is the opposite color to the first real body. In this example of the Harami Cross, it shows you just how it works and also how it's powerful enough to stop a sharp downward trend. Can you spot where the Harami Cross is? Good job. Now let's move on. A harami with a doji as the second session instead of a small real body signals a Harami Cross, which must be viewed as an important top or bottom in the market. This is especially true after a tall candlestick, blue or red line. It is also referred to as a petrifying pattern. Here's a good example of a Harami Cross. It's in the stock Tiffany, symbol TIF, and shows you how powerful these Harami Crosses can be in stocks, big and small. It changed the direction of this stock. Can you spot where the Harami came in? Congratulations, you found it. Now let's move on. When you see a hammer on either a daily, weekly, or monthly chart, it is an important bottoming candlestick line. The hammer and the hanging man are both the same line. That is a small real body, blue or red, at the top of the session's range and a very long lower shadow with little or no upper shadow. When this happens in a downtrend, it becomes a bullish hammer. For a classic hammer, the lower shadow should be at least twice the height of the real body. Here's a very good example of a hammer. This is on MGM Resorts International, and it happened very close to the very bottom. Can you spot it? Yes, that's right. Now let's move on. Following an extended downtrend, this particular candlestick line has a long upper shadow and a small real body at the lower end of the session. There should be very little or no lower shadow. It has the same shape as a bearish shooting star, but when this line occurs in a downtrend, it is a bullish reversal pattern. Confirmation is normally in the next session with a strong blue candlestick with a higher close or higher opening. Here's a great example of an inverted hammer in a very well-known stock. Can you spot where the inverted hammer comes in? Great, you found it. You see how easy this is now? Once you know what you're looking for, how you can tell how markets should react afterwards. The hanging man and the hammer are both the same type of candlestick line. They both have small real bodies, blue or red, with little or no upper shadow at the top of the session's range and a very long lower shadow. In classic Japanese charting, you should wait for a confirmation the next day. In principle, a hanging man's lower shadow should be 2 or 3 times the height of the real body. The hanging man formation in this stock is pretty easy to find. Take a look. Can you spot it? We're looking at the stock GLD. Congratulations, you just found it. Now, let's move on. We've come to the end of understanding candlestick charts. I hope you enjoyed this presentation, and I hope you learned a little bit more about how candlesticks can help you in your own trading. I'm Adam Hewison from MarketClub. Every success using candlesticks. I'll see you on the web.